Michael Loftus, Wealth and Wisdom TV. Talk a lot about our market cycles. Great book, Mastering the Market Cycles by Howard Marks, okay? Big part of our process, all the different cycles. We're currently in cycle 2, which you should know by now. Should have done this before, but I'm going to go a little bit deeper today. As we do see changes, I will add in-depth videos. So sit back, grab that cup of coffee. Let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, we do regular educational videos, market updates twice a month, and now a straight talk. Today is going to be a little bit of an educational video where we're going to talk about the market cycles. If you've watched one of my market updates before, I get into this, okay? What I'd like to do is go a little bit deeper so you understand, and also this will allow me to shorten our market updates, okay? So, 4 cycles, 4 seasons, not including our man, Frankie Valli. But right now, we're in cycle 2. So what does that mean, okay? And how do you know that? Well, there's a couple things. One is growth starts to accelerate, okay? I'm gonna explain all this. Inflation accelerates. If you watch my videos, you know that. And Fed is very hawkish, okay? So that's where we are right now as a cycle. So let's dig deep into this, okay? And the idea of understanding, or as Howard Marks says, mastering the cycles, is to get this information so you can get there early, hopefully, okay? So the first thing you look for is strength in GDP, growth domestic product. Obviously, you see this line first quarter 2021. I'm recording this March 11th. We're seeing the biggest rate of change growth year over year in history, okay? So there's your growth picture. Then you've got the earnings, okay? When you look at earnings, yeah, sure, you look at that, don't see a big number across the board, but it is in fact above, and from a rate of change perspective, is actually very favorable. So we've got our growth. Now let's look at the inflation, okay? So when you see inflation, there's a couple things we look for, right? PPI, you can see that pretty obvious line going up, okay? Of course, the big one is CPI. Now this is Consumer Price Index. The problem with the CPI that the Fed uses is it doesn't really affect us, individuals, on the everyday. So let's take a look at some sectors, okay? You've got copper going through the roof. Lumber, I have these charts a little bit smaller, but it wasn't long ago we were at $300 on lumber. We're now in the $880 range, and if you're building a house, you know what I'm talking about there. Corn, oil, which has been one of our biggest holdings. We have really seen a big push there. Wheat, corn, and I could go on and on, okay? Agriculture, a lot of different things, anything that's associated with the commodity basket. So there's your inflation picture, okay? So now we're looking at the Fed policy and if they're hawkish. So there's 2 things you look for. Low interest rates, which we've had now for over 10 years, and we have the lowest in history right now, and that's the Fed overnight lending rate, okay? The other way for the Fed to be accommodating is obviously to print money. I just did a video on that as far as the latest stimulus. You can click and watch that. But, you know, we really started pumping it, slowed down. We're actually finally starting to burn some of these assets off, and we've gone straight up. We're now in the $8 trillion, and that's just the Fed balance sheet from purchases they've made. So you have your growth story, you have your inflation story, and then you've got the Fed being very accommodative. So then, what else do we look for? Okay, well, before I go there, funny thing, you see Chairman Powell pumping in that money, making this bull nice and fat. So I talk about the dollar a lot. If you get the dollar right, you get a lot of things right. So going back, that's cycle 4. There was a time in cycle 4 back in 1819, we owned the dollar, okay? In cycle 3, you start seeing it go down, and then of course you see a crash. Right now, I see that down here as nothing more than a counter trend move. So you look for the dollar and see how that's behaving, and here you're seeing it go down. Now, the big story in the last couple weeks has been the U.S. Treasuries and have they gone up right now. Big deal, right? I mean, the other day we're at 1.52%. It's not that big of a deal. But from a perspective, when you look at it, it has in fact gone up quite a bit, okay? Now, as much as the market was going crazy and all the CNBC TV analysts, it's actually a good thing, okay? Because it says we're growing. If we're growing, the bond market is going to tell us, okay, by seeing rising prices or rising yields on the Treasury. Now, the problem is, this is a good article this week, right? I talk about this a lot. The death of the 60-40 portfolio and buy and hold. That's a big issue for a lot of people, especially retirees, right? The interest rate is nothing, CDs, money markets, and now bond rates are going up, which means prices are going down, which means those 64 portfolios don't look too good this year. Okay, so you bring all that together, and that's why we've had this bullish move here since November. Now, compliance won't let me tell you exactly when, but back in November is when we started positioning, changing to these assets. Actually, it was October, okay? Now, you see we've had this big trend to the upside. We have here what's called a bullish channel. All of that looks very good right now. We had this breakdown. Why? Just discuss it. Kind of an overselling of the markets because of the 10-year going up. It seems as though things are changing. The market's obviously accepting this. Now, there's some other things I see here in this picture. I'll go over that in my next market update on the 16th. But, you know, what do I see here? I mean, what you see is what you get, right? Low and calm volatility, had a couple different spikes, but most importantly, a great time to buy risk-on assets. So that's the other thing. Each cycle has assets. This is why this concept of buy and hold or asset allocation, traditional asset allocation, really no longer works, especially if you're following the theory that we do on market cycles. But you're seeing it. Tech sector obviously doing well, not in the last couple weeks, obviously, but in this run-up we have small mid caps, without a doubt. Now, if the dollar's down, you have an opportunity to take advantage of that with certain asset classes that do well, right? Inflation assets. I just showed you. We've owned lumber, agriculture, copper, corn, and we still have a pretty big position in oil. Bitcoin, different ways to own that. But the reason I say that is it is non-correlated, like all these assets, meaning dollar goes down, it goes up. So that's something you can look at. And then emerging markets. Now, for us, we do a lot of individual countries, okay? But overall, you're seeing that. Now, today, as I record this video, I'm seeing a lot of overbought signals. So when interest rates on bond yields go up, who benefits? Banks, right? That's been a real nice position for us as well. And then consumer discretion. Consumer staples does well in cycle 3. Get to that later. But consumer discretion, high-end ticket items continue to go up. So to kind of give you a high-level view, this is what our portfolio looks like as of today. All right, again, I can't give specifics because I use primarily ETF and stocks, but some things you might find interesting. Let's start with the bonds. Then this is my 60-40 portfolio. I'm only 16.25 in bonds. Why? Because if you're in bonds, you're losing money. Okay, it's dead weight. It's going to bring your portfolio down. I am holding a little bit more cash than normal. That's going anywhere from 8 to 20%. Okay, core of those assets I talked about, which is large cap growth, momentum, tech, semis, marijuana, okay, emerging markets, EFA, which is international. We talked about that. Some of those cycle 2 assets are going to be what we mentioned as well, consumer discretion, oil, etc. Okay, then we've got stocks. Now, same thing applies. Right now, we've got about 15% in stocks, 8 individual holdings, each of those in different sectors that do well in this particular cycle. The last thing is going to be We have some hedging opportunities. So again, let's bring this all back together. The cycles do move. As of right now, as I said, we saw that change back in late fall. For now, we see it going through the second quarter. Seeing some cracks, a couple of different things right now that give me pause a little bit. More to follow in our next video. But we do feel we're going to go 3-4 as the year goes on. I will tell you an example. China is one of our big holdings, because they've already entered cycle 3 and we've sold out of that. So hopefully this gives you a deep dive into cycle 2. As we get closer, as we position to another cycle, I'll do another video like this. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.